Welcome back to the other second last half of chapter 7. Okay, so in this case, right, if you remember when we were talking about chapter 5 and chapter 6, right, we separated them by one being purchases and then the other chapter being sales. In this case, because perpetual inventory, right, not only does purchases affect our inventory, sales also affect inventory. So in this case, the second half of chapter 7 is going to be talking about sales, okay? And then chapter 8 is where we actually move into the costing methods, okay? Because in this case, when we look at perpetual inventory, sales is a huge factor because that is what decreases our inventory, okay? Where our purchases is what increase our inventory. And with the word perpetual, right, we're constantly updating our inventory as we go, okay? So once again, we talked about what the nature of a business does, okay? Because the ultimate goal of a business that we're currently looking at, right, is we have the goals to make money, right? Get our natural resource and turn it into a goods or service, all right? And here we're looking at trying to sell our goods. So that's the reason why we purchase them, is to, at the end of the day, add something to it, make it unique, or even just, just sell the product for a given specific price, right? And the selling price is going to include all the costs it took to get the item to the store, okay? So everything that we learned through the purchase, so including freight, sales tax, and shipping, whatever it is, right? Plus a certain profit percentage, because at the end of the day, we're not trying to make a loss here. We're not trying to break even. We're trying to buy a product that is, relatively cheap, okay? And at the end of the day, right, we're going to sell the product for either a certain profit percentage, because again, we ultimately want to make money. Okay, so if I buy something at $1, I may charge $5 for it. So that means I get $4 out of selling this product. Okay? And of course, when we're dealing with sales, right, because depending on what state we are doing business in, right, it doesn't matter where we live, right, it matters where the business is being taken place of. And of course, if we deliver it out of state, we're going to charge on wherever that person is buying from, okay? And in this case, we need to charge sales tax. And for this class, sales tax is going to be 8.25%, okay? When we dive into QuickBooks, we will take a look into why sales tax is going to vary, especially in different counties, different areas. Even though they are in the same state, it's actually a percentage of it is part state and the other one is part county. Okay. All right. So let's go ahead and introduce the first part, which is the sales. Okay. So we've seen this before in chapter 6. Okay. Where we need to introduce how we got the money, we just increased the sale, and we're going to be introducing sales tax. Okay, so in this case, on June 1st, okay, 10 toys were sold at $9.99 each. Sales tax is 8.25%. And of course, the toys were originally purchased for $5.85 each, okay? Record this sale. So in this case, I have an extra piece of information. In my books here, I am selling it at $9.99. However, it cost me $5.85. So in this case, right, we have our selling price and we have our cost, right? Now, first, let's think about it this way. We need to sell something before we can get rid of something, right? Makes sense, right? You can't get rid of your items if you haven't sold anything, right? So in this case, we're going to focus on that one section is focusing on the sales, right? And then we will introduce you to the cost of goods sold, which we have seen before, right? We don't see cost of goods sold until chapter 5, right? Where we start calculating how much items cost me when I sell it. But in this case, this is what we're going to do because we're using perpetual inventory. Our first journal is going to be, let me record the sales. And then I'm going to record how much it cost me to get rid of that item, okay? So here's the first part. We're going to record my sales, right? However you received, whether it's cash or accounts receivable, right? We're going to have the sales and the sales tax. So in this case, I sold, right, 10 toys at $9.99. So that gave me $99.90. Tax is 8.25%, which gave me $8.24, giving me a grand total of $108.14. Okay, that is me selling my items, 10 of those items plus the tax, and this is the amount that I got. Okay, so here's us recording the sale. Now, as I mentioned before, you're going to be introducing to a second portion, which is the cost of goods sold. Okay? So in this case, I want to know how much did it cost me to sell those items, right? And we've seen this by when we calculated our inventory worksheet. This is what happens when we need to adjust our inventory because in this case, right, we end up selling our items. How much did it cost me per item to sell? So in this case, we have this piece of information right now. It is $5.85 each item, okay? And of course, because we're adjusting our inventory, we're going to be taking it out directly from inventory, okay? To adjust our account accordingly. All right, so that's exactly what we need. So if it's going to cost me $5.85, right? I sold 10 of those items. So 10 times $5.85 is going to be $58.50. Okay? Now, we are not going to be focusing on determining the selling price or determining the profit because we are not profit managers, okay? Our main goal is just to record the transactions, right? I sold something, I need to keep track of how much it cost me, and that is it. Your job is not to be the person who's in charge of how much money you make at the end of the day, okay? That's someone else's job, all right? So in this case, this is what you're going to be given, right? And then this is what you're going to be journalizing. But as you can see, right, we made roughly a $40 profit. So very close to almost 100% profit. You know, just, you know, if you're curious. All right? Any questions here?
No.
Okay. 7.5, okay? So that's a huge difference when it comes between periodic and perpetual sales is that periodic, you only record the sales. You don't adjust your inventory because we don't do it till the very end of the accounting period, right? Where perpetual, every time we sell something, we must adjust our inventory accordingly. That is how we keep a really good track record because every time we sell something, it gets rid of our inventory. Every time we purchase something, we're increasing our inventory, right? And that's how we know at the end of every day, right? Or at the end of every single transaction, we know exactly how many items we have left in inventory. Okay. So now I'm going to talk about sales returns and allowances, because of course, if you're going to sell a product, you have to also be willing to have to remember, not everybody's gonna like your product, right? If you have the ability to sell, you also have the possibility to get a return and allowance, okay? Why? Things when customers buy the product and then take it home, it could be broken, it could be defective, it could be damaged. Maybe they don't want it anymore. Okay? So again, for those that get a lot of gifts from other people, right? Usually they give you a gift receipt, and if you don't really want it, go and return it, right? Or if they use the product and they're just completely extremely unsatisfied with it, of course, and then if they complain about it, then that's really it, right? You just have to accept that a customer doesn't like your product, right? And that means the possibilities of sales returns and allowances is possible, right? But of course, as a company, our main goal, once again, is to not have those returns and allowances take place, right? We have to set up some rules and some policies to ensure that when we sell a product, we keep it sold, okay? You don't want to have infinite amount of sales returns, because again, when you sell a product, there are people out there that do shop like this. They buy, return, and they use that money to buy another product and then they come back and return it. Yes, there are some people who are like that. Unfortunately, with that being said, that's why we have to come up with some kind of company policies to ensure that when a product is sold, it stays sold. Okay, so then when you get your profits, right, instead of fluctuating up and down because you're constantly returning the product, right, you have a steady, inflow of cash, right? So in this case, right, what are these company policies that you could put on there? Again, most common ones are you could give a full refund within, some of them are 7, 14, maybe 60, 90 days, right? Whatever you feel the most comfortable that you allow your customer to do, right? Give them time to utilize the product, to its maximum amount of time, right? Some of them are, especially electronics, most of them are usually 7 days or 14 days, depending on what that product is. Again, you can have, you can only allow store credit. So if a person decides to return something, you can offer them store credit instead of a full refund, right? Because then that keeps them having to shop and buy something within your store. Okay, and then of course, you can have it final sale, and then of course you can even either reissue a new product or do a full exchange. Now, when you do this, right, you must include sales tax. Okay, sales tax, right? It's not your money. That money belongs to the government, and this money is also going to be one of those things that it's the customer that put money into into buying the service, right? It's their money that they are contributing to society. Okay. Now, of course, with that being said, right? So again, if you charge tax and you are giving a return, right, you must refund a portion of the money back. Okay. So, for example, here you go. On May 1st, okay, you sold 50 coffee mugs for $5 each, right? And the coffee mugs cost you $1.25 each, okay? All right, sales tax is 8.25%, okay? And then, of course, customer A pays with cash, okay, for the mugs. Record this transaction, okay? So, all right, May 1st, we have some cash because customer A paid us in cash, right? We sold something, and of course, we must charge sales tax. So in this case, customer A bought 50 mugs for $5 each. So sales is going to be $250. Tax on that is going to be $20.63. So in this case, we should be receiving a total cash of $270.63. Now, because we sold something, we now need to record the second part of the journal, which is going to be the cost of goods sold. Now, in this case, this product cost, okay, us $1.25. Okay. Now, with that being said, if it cost $1.25, right, and we sold 50 of those items, well, let's calculate it. What does 50 at costing at $1.25? How much is that going to? How much is it going to cost me to sell those 50 items? So in this case, that's exactly what we're going to do. We're going to solve for 50 times $1.25, which is $62.50. Okay. All right. So there you go. That's how much it cost me to sell those 50 items, right? But at the end of the day, I sold them for $5 each, which yielded me $250. Okay. Now, of course, now that my items are sold, right? Let's see what happens next. If on May 10th, all right, customer A wants to return 10 of those coffee mugs, okay, for a full refund, right? And your store policy was that you can give a full refund within 15 days. And of course, because it was May 10 days later, right? The coffee mugs still cost you $1.25, right, each. So in this case, let's record this transaction. Now, in this case, this is going to be identical to periodic inventory, except, again, we have to think about what has happened here, what the situation is. But the journal for sales is identical. Okay, so in this case, we're going to recognize sales returns and allowances. We're going to recognize that we had to give a portion of the money back, and however the customer paid, which in this case, customer A paid with cash. So in this case, if we are returning 10 of those coffee mugs, right? We originally sold 10 of those coffee mugs at $5 each. So therefore, you got $50. But the tax on that is $4.13. So therefore, you're going to be giving back $54.13. Now, in this case, let's look at this carefully. This customer is returning 10 of those coffee mugs back to us, right, for a full refund. As in, they are handing the product to us and saying, I don't want them anymore. So, what does that mean? That means this customer is actually giving back us the inventory items, okay? So therefore, I have to reverse my transaction because in this case, I must drop it into my inventory and cost of goods sold, okay? And reverse my cost of goods sold because I end up unselling these 10 items. So therefore, I have to revert them and put them back into my inventory, okay? Now, think about it in real life. Of course, you would never actually put your old or, cups that you've sold, you would never put it back into your actual inventory and mix it up with your new inventory items. You would technically put it into, another account for, it's still going to be considered inventory, but it would be like refurbished items or, coffee mugs refurbished, things like that. Because again, especially when we have these types of things, right? Coffee mugs, we don't know what customer A did with them. Customer A could have actually used those cups and decided, I don't need them anymore. I'm going to return them. Okay? So we don't know, and we can't trust that the customer did nothing to them. So we put them in a separate, separate inventory area. But in this case, we're just trying to understand the concept, okay? This time, customer A is returning the product to me. So what I'm going to do is I'm going to put it back into my inventory, right? Now, of course, I'm given that each coffee cup cost me $1.25. That's what I have to do since I have to undo what I sold, right? So therefore, if each coffee cup costs me $1.25, right, and I am returning 10 of them, then I'm going to have to calculate this. So 10 times $1.25, which means I got to put $12.50 back into my inventory, and I need to reverse the cost of goods sold because I unsold something, right? So in this case, I need to take it out from my cost of goods sold, right? All right. Any questions here? So that was just the return. What about if I got an allowance? So again, as a small business, you do have the capabilities to haggle, especially when you're dealing with your customers, right? You want to make sure that the customer is either 100% satisfied or so on and so forth, because especially if you're a small business, right, it's not easy to get customers, right? Especially customers to come back to your store because you're so small, you're brand new. It takes time to build up your company and your brand and the company's name itself, right? You want people to trust your product, but you also want to treat your customers, you want to give them the best service as possible. So in this case, right, if on May 18, customer A wants to return 10 coffee mugs for a full refund, but they end up missing the return policy date, okay? And of course, maybe this customer starts to get mad, okay? And they cause a commotion, okay? So what you can do is you can offer them, you can kindly reject them, but if they're like one of those customers that come in and start complaining about the product and, so on and so forth, again, even if you have customers like that, you still want to keep them coming back to you because, you want to keep your product sold. So in this case, what you can do as a small business owner is you can kindly calm them down and say, you know what, I understand you missed the discount policy, but how about this? How about I offer you a 15% discount? Okay? So in this case, I'm giving an allowance. Okay? Saying, I'm sorry you didn't like these cups, but you know what? You waited way too long to return them. So in this case, the only thing I could do is I can offer you a discount, a 15% discount. So in this case, that's exactly what you need to do. You are recognizing this is an allowance. So again, sales returns and allowance. Because you're giving a portion of the money back, you're also giving a portion of the sales tax money back. Okay? And of course, customer A paid with cash. So therefore, that's exactly what you're going to do. You're going to be giving the customer back cash. Okay? So in this case, right, we're not giving a full refund. We're only giving a portion of the money back. So in this case, we still need to figure out, well, how much did those 10 mugs actually cost me? Or in this case, how much did I sell it for? In this case, 10 times $5, which is what you sold it for, right, is $50. But I'm not giving all $50 back to them. I'm only giving 15% of that money back. So in this case, right, 50 times 15 gives me $7.50. Okay? I need to figure out the tax on that, which is going to be the 62 cents. So in this case, right, that means I need to give back $8.12. Okay. Oh, in this case, right, the customer, right, end up keeping their items. So in this case, they never returned the product back to me because I told them, well, there's nothing we could do. You have to keep the product. So in this case, I can only give you a 15% discount. So at the end of the day, the customers still end up walking away with those cups. Okay? So therefore, there's no need to have to do a second entry because in this case, the customer didn't give you the items back. Right? Right? Any questions here? Right? So again, last section here is 7.6, right? If you're going to have sales, you're going to have a sales discount, okay? Why? In this case, sales and sales discount, right? A sales discount is what's going to pull in your customers, okay? Because again, looking at a customer standpoint, right? We live in a consumer society where, a person needs to determine whether this product is worth spending their money on. And again, a lot of the times, a lot of customers want to save their money too, right? They're not willing to pay your product in full price, okay? So in this case, what do sales do? Sales can, one, promote your store, right? But at the same time, it will entice your customers to want to buy the product because it is on sale, okay? Again, if it's 50% off, they can buy 2 of your products for the price of 1, right? So that would enhance your sales dramatically, especially when you have or are promoting yourself some kind of sales. So that could be, grand opening, promotional sales, weekly advertisements, okay? It could be even store-wide sales. It could be online deals. The list can go infinitely on and on and on. You can even offer your individuals, right, who buy things on an account, right? You could also give them an incentive to take a discount as well, right? A lot of the stores, right, they always say, hey, if you open an account with us, you can save 15% off right now, right? That's another way to keep you coming back to the store, okay? So with that being said, let's take a look at our first example here where we have an in-store sale. So it is now June 1st, okay? And your store is having a promotional sale for all items are going to be 40% off, okay? And of course, a customer buys a total of 10 baseball hats, okay? With cash, okay? Which originally price sells for $10 each. Okay, sales tax is 8.25%, and of course, these hats originally cost you $2.50 each. Record this transaction. So, first things that we gotta do is we gotta recognize first, it has to go in order, right? We gotta figure out how much the sales is originally. Since we have here, it originally cost you $10 each, we need to figure out what the sales is on that. But at the end of the day, this is what you're going to be having in your journal. You're going to have your cash, you're going to have your sales discount, your sales, and your sales tax payable. Okay? So first thing we got to do is we got to figure out how much the original sales was. So 10 baseball hats at $10 each gives me $100. But because the discount, right, is 40%, you're not going to be charging your customers for the full $100. You're only going to charge $60 because you're taking away 40%. That's the discount. So in this case, it's exactly what you're going to do. You're going to figure out what the original selling price is. So in this case, $100. you're going to take the discount off of the sales. So in this case, 40%, meaning it is now, I gotta take off $40. So that means I'm left with $60 that must be taxed. Okay? So 60 times my tax is going to give me $4.95. So therefore, think about it. That is how much cash I'm going to be receiving. $64.95. Right? All right. So this is how you would journalize it. Right? Exactly how we did before. But this time, because I sold 10 of those items and each hat cost me $2.50 each, that will be my second part that I have to include is, well, I sold a product. So therefore, whatever 10 times $2.50 is, which gives me $25 and, yeah, $25 even. Okay. So then, once again, that was dealing with an in-store sales. So let's take a look at what happens when I give my customers some terms, okay? So in this scenario here, right, it's July 1st, and of course, a customer wants to buy in bulk 100 baseball hats from your store, okay, on an account. Okay, and of course, because they're a first-time customer, you actually offer them an opportunity to take advantage of, right? But it's a condition, right? You offer them terms of 5% if they pay you within 15 days. If not, then the entire bill is due in 30, okay? Each hat costs you $10 each, okay? And of course, sales tax is 8.25%. And of course, because they wanted to buy in bulk, you kindly said, I can deliver it to your house for $10 charge for delivery, okay? So, and of course, each hat costs you $2.50 each. So let's record this transaction, okay? Since we put it on accounts receivable, right? We put it on an account. We have to recognize the sales. We have to also recognize the tax, and we also have to recognize the amount of money that I charge for delivery. So in this case, right, 100 times 10 is $1,000 plus tax of $82.50 plus $10 to include for the delivery charge will ultimately give you $10.92.50. And of course, we have to also recognize that we sold 100 hats, okay, which cost me $2.50 each. So I need to figure out what my cost of goods sold is, which is, right, 100 times $2.50. So therefore, it's gonna be $250 that I have to adjust my inventory for. Okay? And of course, because this is a condition, right? So if it's on July 12th, okay, and the customer decides to pay for their purchases in full, right? And of course, the terms were 5%, 15, net 30, since they bought it on July 1st and they're paying on the 12th. Therefore, they made it within the discount terms. So in this case, we must give them their 5% discount. So in this case, right, because we've already charged them, right, we already charged them and we said we placed it on an accounts receivable, right? So what we have to do is we have to note that, okay, we're going to get paid, right? But we're not going to get paid in full because this guy is going to get a discount. So therefore, we got to recognize it like this. We are going to get cash at the end of the day, but I have to also recognize a sales discount, which is going to decrease your sales, right? And because we already charged the tax, we have to give the portion of the tax money back as well, okay? Because these items are now discounted. They're not in full, they're discounted by 5%. So in this case, what we gotta do is we gotta go back and backtrack, right? What was my original sales? In this case, we sold 100 hats at $10 each. So therefore, $1,000 is what I am looking at, okay? And I need to find out what the discount is off of those $1,000. So in this case, 5% of $1,000 is $50, okay? And because we charged tax from the previous one, right? We charged it at $1,000, right? We need to now determine what 50 of those dollars is going to be taken away the tax for. So in this case, I'm going to take my $50, multiply my tax, which is $4.13. So that's what I'm going to be discounting from the amount that customer A owes me. Okay? So therefore, right, even though I made a record saying that customer A owes me $10.92.50, right? If customer A decides to miss that payment, or miss the discount period, then that's what they owe me. But because they made the discount period, right, we need to adjust the account accordingly because we are selling the items at a discounted price. So in this case, right, it's going to take away $54.13. So therefore, I should be receiving a check or some kind of cash, right, for $10.38.37, right, which is going to be the $10.92.50 minus out the $54.13, right, the discount plus the tax, right, which will result in how much money, okay? And of course, because this is someone paying for what they owe, which has no effect on inventory whatsoever, so therefore, that is it. Okay? Any questions? Okay. So again, a sales discount has no effect on the actual items itself because at the end of the day, it's what it cost you to sell, right? So at the end of the day, you're not going to be discounting the inventory item. You're only discounting the selling price, okay? Just a little heads up there. Okay? So our course review here, right? We have purchases, right, which we know, right, how to journalize. However, when we sell our items, we have to include this right here where we have our sales and we have to include our second entry here, which basically adjusts our inventory. Okay, so there you go. That is this. Okay. And of course, we talked about sales returns and allowances, right? What happens when we have a sales return allowances? It really depends on what you're doing. If you have a sales returns, right, you are having to have that second entry because you need to reverse the items that you're getting back. If it's an allowance, you only need to do the returns and allowances, and that's it because the customer ends up keeping the product at the end of the day. And of course, we talked about discounts, right? We talked about in-store discounts, and we talked about, what happens when you give discounts to your individuals that owe you on an account. Okay. So let's go ahead and dive right into the chapter 7.4, 7.5, 7.6, Perpetual Sales Exercise. Okay. So here on April 5th, you sold 100 cups at $5 each to customer A for cash. Now, before we do that, let's read the instructions. Number 1, journalize. Okay, assume that sales tax is 8.25% and you purchase a total of 500 cups with all cost equaling to $1.36 each. So here's your cost per item is $1.36 each. Okay. So first one here is on April 5th. You end up selling 100 of those cups at $5 each to customer A for cash. Okay. So it's April 5th, right? You're selling 100 of these cups for $5 each to customer A for cash. So how am I going to journalize this? Accounts. No. How did customer A pay me? How did they pay for their items?
Cash.
They paid with cash. Okay. All right. And what did I do here?
Sales.
You had some sales, right? You sold the coffee mugs. And last but not least, what do I need to charge?
Sales tax payable.
Okay. So in this case, if I sold 100 cups at $5 each, what is my total sales? What's my tax on top of that? $41.25. So therefore, I should be collecting $541.25. And I'm going to make a note here saying that I sold 100 cups to customer A. Okay. You can also wait to hold off this description and put it into your second half of the portion. Okay. But in this case, I'm already here. I already did it. So, okay. So what's the next section that I have to do as part of this? Because I end up selling 100 of those cups. I have to include my second entry here, which is calculating the cost of goods sold. And where am I taking it out from? Inventory. Yes, I'm updating my inventory. Okay. So if it cost me $1.36 each and I sold 100 of them, how much is my total? What was that? Sorry. 136. Okay. So 136. Okay. This is where you could have put this right here, that you sold 100 cups to customer A. Okay. What about April 7th? Okay, you end up selling 25 cups at $5 each to customer B on an account, and you gave customer B terms of 10%, 15, net 30. So in this case, you sold 25 cups for $5 each to customer B.
Accounts payable.
Yes, because I sold it to him on an account. At receivable, not payable. Okay, accounts receivable.
Yeah.
Good. What else do I need to recognize?
Sales.
Well, I have a question.
Mm-hmm.
Why is April 5th cash and April 7th is accounts receivable?
Because it says right here on April 5th, customer A paid me for cash.
Oh, sorry.
And then customer B placed it on an account.
Okay, sorry.
No worries, no worries. It's okay. All right. So there you go. All right, sales. And then we need to charge some tax. Okay. So in this case, I sold 25 cups at $5 each. Okay. So what is my total sales going to be? I sold 25 cups at $5 each.
125.
How much tax is going to be charged?
$10.31.
$10.31. So therefore, I'm going to be, or customer B owes me $135.31. Okay. You can place your note here as well. You can say you sold 25 cups to customer B. And of course, it's on an account, so you're going to offer customer B 10% if he pays within 15 days. If not, it's due in 30. Okay? Making sure that's correct. Yes. All right. On April 10, you sold another 50 cups for $5 each to customer C for cash. Okay, but in this case, right, I have my sales. What else do I need to include?
Cash.
Well, in this case, I'm going back to the previous one, right? Because in this case, I recognize my sale, but what else do I need to include?
Cost of goods sold.
You need to update your inventory. So you're going to have the cost of goods sold. And it's going to come directly out from inventory. And okay, so in this case, if it cost me $1.36 each and I sold 25 of them to customer B, how much is it going to cost me? What's my cost of goods sold?
$34.
Okay. Right. Now I can go ahead and do April 10, where I sold 50 cups for $5 each for cash to customer C. So I have to do cash. What else?
Sales.
Sales and sales tax. Okay. But of course, in this case, that's what that I'm just gonna copy and paste this because that's what I can do, right? So in this case, I sold 50 cups for $5 each to customer C for cash. So in this case, I sold 50 cups for $5 each.
$2.50.
Right, how much tax is going to be charged?
$26.63.
Say that again, $20.63?
Yeah.
Okay, so therefore, $270.63. Okay, and I sold 50 of those to customer C. Now, if it cost me $1.36 each, how much is my total cost of goods sold?
How much did we get them for?
$1.36?
68.
$68. Okay. Right. So then let's see what happened next. Let's see. Okay. April 15 rolls around and customer A decides they want to return 10 of those cups for a full refund. So customer A returns 10 cups for a full refund. So let's see, when did we sell to customer A? We sold to customer A on April 5th. So let's see, you sold 100 cups for $5 each to customer A for cash. Okay, now customer A wants to return 10 of those cups for a full refund. Okay, so first off, how did customer A pay?
Cash.
Cash, so we have to give them back cash. Okay. Second of all, how much did I sell each cup for? $5 each. So in this case, that's exactly what I need to know. Okay. So let's see. It is April 15. Okay. In this case, customer A is returning. So what account do I need to use?
Sales, return, and allowance.
Sales, returns, and allowance. Good. Okay. What else do I need to give back?
Tax.
You need to give a portion of their tax money back. Okay. And last but not least, how did customer A pay me?
Cash.
Cash. So therefore, I'm going to refund customer A with cash. So in this case, they are returning 10, right? 10 of those cups. Okay. Okay, so it cost me $5 each. So therefore, what's my total sales, returns, and allowances?
50.
$50, right? 10 times 5 is $50. How much of that money is going to be taxed that I have to give back?
So I have a question. I don't think I'm calculating it right, or either my calculator isn't working. How do you do the tax? It's multiplied by 8.25.
Yes, but in this case, because it's a percentage, if you're using like a regular calculator, you do have to convert that percentage into decimals. So in this case, what I do is I go 0.0825.
Oh, okay.
Mm-hmm.
Mm,
Make sure it's 0.0.
0.0825.
Mm-hmm.
So it would be $4.12. or 13 because it's 0.125.
Tax is always going to be rounded up.
13.
Mm-hmm. So in this case, I'll be refunding $54.13. Okay? And of course, I need to make a note here that customer A returns 10 cups. Now in this case, let's take a look. Customer A actually came in and returned 10 of those cups and we gave it for a full refund. So what does that tell me? They're actually returning the product. So what does that tell me?
Inventory change.
I have to put it back into inventory. So in this case, inventory. Well, actually, inventory is supposed to be cups, but that's okay. Inventory. Okay. And what else do I have to put back?
Cost of goods sold.
Because in this case, I'm undoing what I sold. So if it cost me $1.36 each, right, and customer A decides to return 10 of those items, how am I going to calculate how much is it that I have to put back into my inventory and take out from my cost of goods sold?
136, you said?
$1.36, yes.
1360.
$13.60 is what I have to put back into my inventory, and that's how much I have to take out from my cost of goods sold. So then again, in this case, I'm just going to say returned 10 cups. Right? It doesn't belong to customer A anymore, so therefore you just simply put in that you end up returning those cups. Okay? On April 20th, right, customer C returns 25 of those cups, but is willing to accept a 15% discount. Okay? So customer C, okay, wants to return 25 of those cups, but is willing to accept a 15% discount. Okay? So in this case, it is April 20th. Right? Customer C is wanting to return 25 of those cups, but is willing to accept a 15% discount.
Sales return.
Sales returns and allowances. And how did customer C pay me?
Cash.
He paid me with cash. So in this case, that's exactly what I got to do. I have to do a sales returns and allowances, give a portion of the money back because the items are now discounted. Okay? And I also have to give him back cash because that's how he paid me. So in this case, 25 25 cups were sold but are discounted for 15%.
Is it 125?
125. No.
No.
So 25 times 5 is 125, right? That's the full price of the refund.
1875.
But but I can't give them back the whole refund because he was willing to accept only 15% of that money back. So in this case, I need to multiply it by my 15%, which is give me $18.75. Because again, this is an allowance. I'm not giving him all the money back. I'm giving only 15% back. Okay? Now, out of the $18.75, how much tax am I going to be charging?
$155.
Okay, so that means I will be giving $20.30 back. Okay. And I want to make a note here that customer C returns 25 cups for 15% discount. Okay. So, did customer C actually return the product back to me?
No.
No. So in this case, no need for that second transaction there. Okay. Last but not least, on April 22nd, customer B decides to pay in full for his purchases and meets the discount. Okay, so we gave him terms of 10%, 15, net 30, right? We sold it to him on April 7th, and 15 days later is April 22nd. So he just barely made the discount due date. So in this case, customer B is going to pay for his purchases and he meets the discount. In this case, it doesn't specify how he paid, so it's your choice. It's either he paid in a check or he paid with cash. But in this case, he's making a payment for what he owes me, and he needs to be discounted. So let's take a look at the transaction on April 7. Okay. April 7, right? Accounts receivable. His sales, total sales was 125 because we sold 25 cups to customer B. The tax was $10.31. So what customer B owes me is $135.31. Okay. So how should my journal look like?
Is it sales return and allowance?
Customer B is not returning any of the items. He's just paying for what he owes. And what are terms?
Discount?
It's a discount. Good. So in this case, however we're receiving the money, right? Whether it's cash or a check, right? Customer B, right, is going to be receiving a sales discount because he's going to get his items discounted. What else do I need to give back?
Tax?
Yes, we had to give a portion of the sales tax money back. And last but not least, he's reducing what he owes me. Okay? Right? So in this case, right, he owes me $135.31 right now, right? Now in this case, the discount is 10%. Which amount can I take this 10% out from?
125.
125, right? You can only take the discount off of the original selling price. You cannot take it off of tax or shipping or anything like that. So in this case, I have to take the 10% discount off of the original sales of $125. So in this case, what is my total discount here?
$12.50.
Okay? Out of that $12.50, how much of the tax money do I have to give back? Because in this case, I charged customer B for the full amount for the items with the full tax. But because he's getting a discount, right, off the items, I have to also discount the sales tax as well. Or not discount, but give the portion of the sales tax money back as well.
103.
103. Okay? So $12.50 times 0.825% should give you $1.03. So in this case, how much is customer B actually going to pay me?
$121.78.
$121.78. Okay, so it's the amount that they owe me minus out the discount and the tax. Okay, and I'm gonna make a note here saying customer B paid in full, received 10% discount. Okay. And that is it for this section here. Any questions?
No.
Okay. All right. So what I'm going to have you guys do